Hello everybody and welcome to our discussion on the sole community hospital and Medicare dependent hospital base year target rates. So for this discussion we are going to be talking about an overview of the base rate and how it impacts the sole community or Medicare dependent hospital payment, and we'll break this down through a discussion of the cost per discharge, how the Casemix Index comes into play, and the fact that we inflate the rates to the current year. And then we will go through each of the individual base rates, including the 1982, 87, 96, 2002, and 2012 base rates, and talk about what type of facility they apply to and what year they updated to. We'll talk about what happens when one of the years is missing, and then we will discuss issues with calculating rates for new providers. So before we get started, let's talk about the base rate itself and how that impacts the payment. So we know that the sole community and Medicare dependent hospital providers, they're reimbursed based on the higher of the federal rate per discharge. Now I have that in quotes for a reason. We'll talk about that in a couple of slides. But it's the federal rate per discharge or the updated hospital specific rate per discharge. Now when I say they're based on the higher of the two rates, that is true for sole community hospitals, but for Medicare dependent hospitals, they're only reimbursed 75% of the excess difference. So they don't get paid the entire higher amount. They get paid basically the federal rate plus 75% of the difference if the hospital specific rate is higher. Now, over time, these base rates are recalculated or rebased every so often to take any changes in the cost structure of that provider into consideration. Now, it doesn't happen all the time, and as you can see, based on just the agenda itself, these are the times that the base rates have been rebased. So when we talk about a base rate, we're starting off with a cost per discharge. That's the idea here. We want to know how much each discharge has cost the provider historically, and we use that, we update it, we inflate it every year based on the market basket update factors to approximate how much that should cost them in a later year. The goal with the hospital specific rate is to mimic what's going on with the federal DRG payments. Now, the idea here with the federal DRG payments, these are obviously calculated based on data that CMS gets. A lot of it does come from the cost report, but there are other factors that come into play. Essentially, it's the average cost of all providers in a certain region for a particular mix of services. Now, again, all the providers in your region would have factored into that federal DRG payment. The hospital-specific rate, as the name implies, it's specific to that one hospital and their base year data. So instead of using a rate developed based on all hospitals in the region, you get to use your own rate based on historical data. Now again, it's not cost reimbursement like a critical access hospital, so it's not that year's cost data, it's some base year's cost data. So cost per discharge is, of course, a cost divided by the total number of discharges. Now that'll be multiplied later, in a later year, the year under review, by a new discharge count to get a current year hospital-specific payment. Now this discharge I have in quotes again because we're not truly using the discharge count. Instead, we're using what's called a DRG weight. Now what that basically means is every discharge is not equivalent. You may have some discharges that were very intensive, cost-intensive discharges, and other ones that were very simple discharges. Now that may differ. Your mix of discharges in this current year may very well differ from the mix of discharges you had in your base year. To take that into consideration, the base rate was Casemix Index. So the formal term for this cost per discharge is Casemix Index adjusted cost per discharge. So what will happen here is we back out the Casemix Index, or we take into consideration the Casemix Index for that base year, and we get a true cost per discharge that can then be multiplied by the DRG weight in the year under review to take that year's case mix index into consideration. Now, when we talk about the case mix index, again, it weights the discharge based on the types of services that are normally grouped into that DRG. More severe DRGs use more services, they cost more, and they should get paid more. Now, if we take a look at the federal claim payment calculation, just the basic calculation here, we take the labor portion of the federal rate that CMS has calculated and published in the Federal Register each year. Now, that labor portion is, of course, multiplied by the wage index for that specific hospital. And then on top of that, a non-labor portion of the federal rate, also given by CMS, is added in. That entire federal rate is then multiplied by the DRG weight for that one claim, and that tells you what your base federal payment is for that claim. Of course, there are other things that get added on top of that. DISH, IME if you have it, and of course there are the GME payments, nursing and allied health. This is just the base federal payment. But again, the key thing here is that it was multiplied by the DRG weight, which essentially brings in the case mix index. The DRG weight can be thought of as the discharge multiplied by that case mix index for that particular DRG. This is just an illustration of the rates themselves. We don't actually need to dig too deeply into that. Again, the DRG weight that I'm referring to here, you can think of that either on a claim-by-claim basis or in aggregate. If you're running a PSNR for your cost reporting period that's an entire year, that PSNR DRG weight is the aggregate of every claim's case mix index. Again, some were worth less than one, some were worth more than one, but overall, it's an average of those DRG weights. And again, every year is going to be different. Your base year may very well differ from the current year under review. You may have had a higher mix of more complex services or might have gone down. But the point is that the base year should have the case mix index adjusted out of it to get a raw cost average per discharge, and then we can multiply that amount by the DRG weight for the year under review. That's the whole point here. Now the question is, where does the case mix index come from? Historically, the case mix index has been published annually in the Federal Register. Now keep in mind this is a federal fiscal year, so it's 10/1 through 9/30, and it reflects the mix of claims made during that particular federal fiscal year. Now, if you have a different cost reporting period, a 12/31 or a 6/30, one could argue that it might not be appropriate to use a 10/1 through 9/30 CMI to adjust out the cost per discharge from a non-federal fiscal year cost reporting period. That argument seems valid, but by regulation and Federal Register, it is required of these base rates. Now, if you go to the PSNR, depending on which period you run, you would also get a case mix index for that specific period. Now, if you have a 9/30 fiscal year for your cost report, then assuming you haven't had a lot of late claims or late adjustments, the CMI that you get from the PSNR should match what shows up in the Federal Register. Keep in mind, though, the Federal Register is a snapshot of the data they had at that point. If you have claims submitted or adjusted after that fact, even though they relate to that year, they're adjusted after the fact, then of course the Federal Register is going to show the older data. There's just no way around that. So the PSNR, to get the actual case mix index, you would take the DRG weight that's given to you and you would divide it by the actual number of discharges, and that is the case mix index. Even though the label doesn't show up in the PSNR anywhere, that is the case mix index. The issue here is that the regulations and the Federal Register have never explicitly allowed the use of a PSNR generated case mix index. for any of the base rate calculations, and this has always been pointing to the Federal Register, or in some years it's been silent, but there was never any sort of explicit information about, hey, let's change and start using a current cost reporting period PSNR derived Casemix Index. So this has been brought up to CMS, and there have only been very rare situations, and I mean very, very rare situations, where the provider was able to show extenuating circumstances, something major has changed in a portion of the period, where the Federal Register data was absolutely inaccurate, and nowhere close to accurate, and therefore the PSNR should be used. So this has only been allowed in very rare situations. By default, we will be using the Federal Register Casemix Index. Now, just as an example of Casemix Index, so here we have, and these are some slightly older DRGs, but the DRG 202 has a DRG weight of less than 1, 0.926. DRG 001, a heart transplant, has a DRG weight of 25.4484. If we were just to take the DRG weight from the PSNR, just add these two together, that's 26.3744. But if we divide that by the two discharges to get an average, we get an average DRG weight, which is also known as the Casemix Index, of 13.1872. So we use this data, and we're going to see it in a little bit, to calculate base rates, to get that Casemix Index adjusted cost per discharge. Now the key thing to remember here, though, is that base rate is, depending on which year you're using, is quite old. In some cases, you could be using a 1982 base year, and here we're about in 2023 now, so certainly it would not make sense to use 1982 costs to try to reimburse a provider for 2023 services. So of course those base rates are going to be inflated over the years based on the market basket update factors. Now this very topic is going to be discussed a little bit more in the hospital specific payment YouTube video that's being put out at the same time. Now, what happens here is we take that base rate and then we update it using all of the different update factors, budget neutrality factors, and a variety of other adjustments from the last base rate to the current federal fiscal year that we're dealing with. Now, I do want to clarify this point, this last base rate. So we're not... You'll never have a starting point of the 1982 rate, or certainly you would not have for a very long time, because every so often, as we'll see in just a little bit, those rates get either rebased to a newer year or they get brought forward, just inflated up to a new starting point. Again, that'll make more sense in just a little bit, but my point is whatever base rate you have, you need to apply the update factors to get to the current federal fiscal year. So let's talk about how this gets reported on the cost report. Now this carries over a little bit from the other YouTube video discussion, but in this case on E Part A, when we get to line 47, line 47 is the sum of all the different federal rates or federal payments up to that point. I shouldn't say all of them, but all of the DRG-based federal payments, which would include DISH, it includes the high discharge ERD payment, it includes a variety of things, all the DRG-based payments. Notably, what it excludes is your organ acquisition, your GME, some other cost-based pass-through costs, DGME, so it excludes those. Those come after the fact. But line 47 is all the other federal payments. Line 48 is where we report the hospital-specific payments for the sole community or Medicare-dependent hospitals. And then line 49 takes the high. If it's a sole community, it takes the higher of those two. If it's a Medicare-dependent hospital, it takes 47 plus 75% of the difference between 48 and 47. And that carries forward to line 49. Now, after that, you again have all these potentially other payments that get added on top of it. But the point is, it is hold harmless, which essentially means you're not going to be harmed by this hospital-specific payment, and you always get the higher, or a higher number. You'll never get a lower number than what your federal payments would have reimbursed you. So the point here, though, is that we need to identify a number to plug into line 48, and that is the base rate, whatever the most recently inflated base rate was, further inflated to match this particular year in question. Again, this will be discussed in more detail in the hospital-specific payment video, but I just wanted to introduce it here to make a little more sense of the base rates and why they matter. Now we're going to be spending time going through each of the base rates. We'll talk a little bit about each one and how they've been inflated over the years, the history of them. The first one deserves a little more discussion because it's an unusual one. It's different than any other base rate that's ever existed. This is the original base rate, the 1982 base rate, and you can find the definition of this in the regulation at 42 CFR 41273. Now, this one, again, was the very first rate that was ever in existence, and it was in existence for the beginning of sole community hospital status up to 1990. That was all that existed, was the 1982 rate. And each of these regulations, by the way, they define what that year is. I'll just give you this first one. I won't repeat it every time. But the cost reporting period beginning on or after 10-182 and before 10-183. The definition in the later years has sometimes varied a little bit, but again, you'll always find it pretty clearly in the regulation. Now, the important part about this one, this 1982 base rate, that cost reporting period is before the prospective payment system even came into existence. Now, what that means is the data and the data that's reported on the 1982 cost report and the calculations themselves do not take into consideration many of the rules that apply to PPS. For that reason, when we're using this 1982 base rate, it's not actually from the cost report itself. Instead, there was a separate calculation called the target amount computation or TAC report, that makes adjustments to convert this essentially to a PPS rule-based calculation, which is what's required to determine PPS payments down the road. Now, the original purpose of this TAC report was for TEFRA target rates for that short period of time before PPS, basically between cost and PPS. So one of the problems with the 1982 cost report is that both the capital and medical education costs were included in that total cost line, and there was no way to distinguish what that amount was, no way on that settlement worksheet to distinguish what that capital and medical education cost was so we could carve it out. If we go back just right here to this slide, remember DGME and even capital, those are paid outside of the normal base PPS payments. So if we were to use a 1982 cost report that had costs including capital and medical education, we would be double paying for those items because they would also be added on here. If when we calculated line 48 to get a hospital-specific payment, if we used a 1982 base rate that already included capital and GME, we'd be double paying capital and GME because it would be added in here as well. That's the problem with the 1982 cost report. So again, if a MAC were to erroneously use that 1982, the true cost report, then there would be a double payment there. This is the reason that TAC report is required. It goes through and basically recalculates the cost report to separately handle capital and medical education cost, including everything that's stepped down to it. So it redefines the cost report calculations. Now, again, it was something that was audited at the time. Now, if we come across a situation where the 1982 TAC report cannot be found, does not exist, then the 1982 cost report base rate just cannot be used at all. We can't go in there and try to redo what the TAC report was doing, and we certainly can't use the 1982 cost report. So as we'll see in a few slides, there are provisions that allow us to use other base rates when a particular base rate does not exist. So now let's talk about the 1987 base rate. This was the second rate that existed. Now notice here, this one, by the way, the 1990, that's also when the MDH, the Medicare Dependent Hospitals, first came into play. So both SCH and MDH hospitals can now use the 1987 cost report as a base year if it was higher than that 1982 TAC report base year. Now keep in mind, 1987 is after PPS, so we don't have to worry about a TAC report anymore. Notice here that the definition of this year changed a little bit. CMS gave an alternative that could be used. Then we move forward to the 1996 base rate. This was only for sole community hospitals, and there's another thing that's unusual about this base rate, specifically that it had to be elected. So the provider, if a provider wanted to use the 1986 base rate, per this regulation here, 41277, the provider had to elect by a certain time. For this reason, if we have a brand new provider that is getting their base rates developed, they cannot use the 1996 cost report because obviously this time frame has passed. There are no provisions to allow for an exception to that. The other unusual thing about this base rate, that it was phased in over a 4-year period. This has never happened since. And here's just the definition of the phase-in, or the description of the phase-in. Again, that's irrelevant at this point because obviously all providers have phased in if they were electing that. So now we jump forward to the 2002 base rate, and this one was for Medicare dependent hospitals only. Again, we have the regulatory reference. The definition slightly changed again, and no provider election was needed. There was no phase-in. It was just a nice rebase. 2006 rebase was for sole community hospitals only. Again, you see the definition, no election, no phase-in. The one unusual thing about this, if you look at the Federal Register that implemented these regulations, every year up until this point very clearly said you must use the Casemix Index published in that Federal Register. So that Federal Fiscal Year Casemix Index, it explicitly pointed to it. But in 2006, that explicit verbiage was dropped and it was silent. So it just said, hey, use the Casemix Index, but it didn't say where to get that Casemix Index from. So there were some situations where providers were trying to have us use a newly defined Casemix Index. But anytime you have authority that has remained steady over time, then all of a sudden becomes silent, you cannot take silence as a change. There was no definitive mention of where we should now calculate this, so you have to continue on with the existing rule up to that point. Therefore, we must use the Federal Register Casemix Index to calculate that. This is the reference that I was mentioning about if we miss a base year, then we can just use whatever other base years exist. So if you take a look at the Medicare Modernization Act, specifically Section 407, and this talks about how to treat missing cost report periods. It's specifically for sole community hospitals, but it also applies for Medicare dependent hospitals. It's the same underlying rule. It's just that Medicare dependent hospital status was never intended to be permanent, although it's been extended year after year for quite some time. But in any case, it says, in no case shall a hospital be denied treatment as a sole community hospital or payment because data are unavailable for any cost reporting period due to changes in ownership, changes in fiscal intermediaries, or other extraordinary circumstances, so long as data for at least one applicable base cost reporting period is available. In other words, as long as we have other years, we can use the other years even though we're missing 1 year for any reason. Even if it's a change in fiscal intermediary, change in ownership, and therefore the documentation just cannot be found. That's usually what leads to these situations. And of course, obviously, if it's a brand new provider that didn't exist for those earlier years, that's obviously a reason not to use that year. The point is, we can use the data that we have available. Next, I wanted to go through a little bit of a history of the different base rates, not only the rebases that we just talked about from the regulations, but also different periods where CMS required MACs to inflate it forward, kind of catching it up to a certain point and freezing it at that point until the next time. So if we take a look at 10/1/1983, this would have been the very first year based on the 1982 base rate. And in the claims processing system, what we refer to as FIS, or you may refer to as the pricer even, this rate would have been locked in up until 10/1/1990. Now that doesn't mean you'd be paid only based on that rate. The system behind the scenes knows what rate was locked in, and they know what update factors need to be updated to get you to the year in question. At 10/1/90, it's possible that you would have been rebased to a 1987 rate if it was higher, or if nothing else, that 1982 rate would have been further updated to hit $1990. And that rate would have been frozen until 10/1/1994. And again, when I say frozen, I just mean in the system, but then the subsequent update factors are applied behind the scenes in the system. The rate itself wouldn't be changed in the system. The update factors would have been applied separately. 10/1/1994, a couple of things could have happened here. With 10/1/1994, this was simply an inflation. There was no rebase. The update factors were just accumulated, and a new rate was locked in as of 1994. That rate was frozen again until 10/1/2000. Come 10/1/2000, we would have taken either a rebase for the 1996 cost report. This should actually be 1996, or we would be inflating that 10/1/1994 rate up until 10/1/2000 if there was no rebase. So it's either a rebase to 1996 or an inflation to get that rate up to 10/1/2000. One way or the other, the new rate that was entered into the system on that date was based on 10/1/2000 dollars. That would have remained in place until 10/1/2006, and it would have either been an inflation up until 10/1/2006, or it would have incorporated the 2002 rebase for Medicare dependent hospital. The next change was an odd one because it was the next one was no longer a 10/1 date. Instead, it was a cost report specific date, specifically the first fiscal year beginning on or after 1/1/2009. That rate would have only changed for sole community hospitals that rebased to 2006, but at the same time, it updated the data to $2007 to get it into a level playing field. That would have remained frozen until 10/1/12, and that would have been just a normal inflation to get everything up to 10/1/2012 dollars. The last rebate that we have at this point was 10/1/18, and I shouldn't say rebase, it was an inflation. The 10/1/12 rates were inflated forward to 10/1/2018. So again, my point here is that, and as we'll see in just a bit, whatever the rate is locked in at, the system knows. Let's say this was 10/1/18, and we're currently submitting a claim for 2022. The system knows that the rate they see, the rate it sees as of 10/1/18, needs to be updated to whatever your current service date is, 2022 or in a few weeks 2023. So that's the point. It knows where it's starting from and it knows where it needs to be, and it updates accordingly. Behind the scenes, the reason for the inflations and the rebases, the system only remembers, and I use that in quotes, it remembers up to about 6 years of update factors, and then, again, that's why we have to rebase or reinflate every so often to keep the system up to date. We'll see more of that, more of this, when I say keep it up to date, we'll see that in the hospital-specific payment module on that YouTube video. So when our auditors receive requests for new providers that are newly SCH or MDH, what we do is we start with the oldest possible year, we see if there's an 82 TAC report, we see if there's an 87 rate, and we calculate it, we work forward. Because, again, you're always going to get the highest of those rates. So let's just say you had an 87 rate that was quite high, and when we try to rebase to 96 or 2006, those rates are not as high. Now, again, when I say rebase, we're not comparing 2006, we're not comparing the cost per discharge way back to the cost per discharge in the 96 cost report. They're all brought forward to the same year's worth of dollars, and then we do the comparison. In other words, they're both inflated forward. We do the comparison. Whichever one is higher, we use and we move forward with. Keep in mind, if the older rate is not available, then we'd skip to the newer rates. If there's no rate at all available, so it's a brand new provider, there are no other cost reports. They started after 2006. That was the last rebase. Then the provider would get a rate of 0, which means they're not really paid extra for Soul Community Hospital until the next CMS rebase, whenever that might be. So whatever the hospital-specific rate is, that's entered into FIS, or the pricer if you want to use that term, for claims and interim payment purposes. And as I said a few times, the pricer knows what rate you're entering, what year it corresponded to, and it knows what inflation factors need to be updated from that point forward to match the current year in question. And what we're going to see in the next video is a discussion of how that base rate, the inflated rate, gets brought forward to the current period in question. There are a lot of factors that come into play: the market basket update factors, budget neutrality factors, documentation and coding adjustment factors, a rural floor restoration factor, and then furthermore, there are a couple of actual reductions that can apply to reduce the market basket update. If you failed to submit quality data, you have a 2.0% penalty. If you have an EHR meaningful use reduction, you didn't attest to meaningful use, that reduces your market basket update factor as well. So we'll talk about how that all comes into play. This is all discussed in the payment mechanism lecture that will be coming up shortly. You'll see that in a separate YouTube video. So I thank you for your time. I hope this has helped to explain some of the mechanics behind the Soul Community and Medicare Dependent Hospital status. Take care, and I look forward to talking to you in the next session.